Hi, welcome to Main Street Macro. I'm Neela Richardson. One of my favorite things to do on the weekends is to bake bread. It's like magic. You put the ingredients in the right order into the bread machine, close it up, press start, and voila, 3 hours later, out pops the perfect loaf of bread. Rarely in life are things either that precise or that easy. And that's especially true of Fed policy. All eyes will be on the Federal Reserve this week as they try to rein in inflation. But the Fed knows that, ingredients, its own policy can react very differently depending on economic conditions. So here are three things the Fed is looking for in terms of the market reaction. The first is financial markets. How will financial markets respond? You see, the way that the Fed changes its interest rate policy to rein in inflation is really through one key tool. It's called the federal funds rate, and it's basically the rate in which banks lend to each other overnight. Now, most of us will not ever directly encounter the federal funds rate, but this rate actually sets the tone to a lot of other different rates in the economy that we are very familiar with. One is the strength of the US dollar and how much our exports cost and our imports cost here at home. The second level that we watch all the time is stock prices and company valuations. And that rate directly feeds into 401k and investment savings. We also look at the corporate bond market because that impacts both corporate borrowing and consumer borrowing. And then, of course, the overall interest rate levels that have permeate throughout the economy. The Fed is closely watching each of these markets to make sure that they don't overreact or underreact to their changes. The second reaction is how the labor market adjusts. And here there is good news. Just last week, we saw new data that showed that there are 5 million more jobs than there are unemployed workers. Also, layoffs have become much more infrequent and wages are up. People are making dough. But here's the awkward part: wages are not keeping pace with inflation. And in a way, the Fed may not want wages to, because that would trigger something called a wage price spiral, where wages increase, then prices increase, then wages try to chase those prices, and on, and that leads to more inflation. The third response that the Fed is going to watch very closely is the balance sheet impact. The Fed had to do a lot of bond buying over the last 2 years to help the economy grow. They bought $4.6 trillion in government debt. That's a lot of bonds. And now they have this portfolio that they have to decide how to reduce and how to unwind. They took the first step last week when they stopped buying bonds altogether. Now, the last time that the Fed tried to reduce its balance sheet several years ago, it didn't work out so well. Credit markets actually dried up. This time around, its balance sheet is almost double the size. It's $9 trillion, and it's never had to unwind such a big bond portfolio before. The Fed will be watching very closely on the impact of that balance sheet on both companies, markets, and consumers. You know, baking Fed policy and interest rate policy is not like baking bread at all. You can't just put the right ingredients in the right order and wait a little time and get the same result every time. In fact, that's what makes this recipe of reining in inflation very tricky indeed. Thank you for watching the Main Street Macro. For more information on the week ahead and how Fed policy will affect Main Street, which is the bread and butter of the US economy, please go to adpri.org.